Good afternoon. Hi everyone. Welcome to the fourth episode in our webinar series. We are going through them. So welcome to number 4. So if you're the first time joining us today, thank you. It's fantastic to have you. If you're coming back and joining us, or you've joined us previously and you've come back for more, welcome back. Like I say, it's fantastic to have you all here. So we have a topic today that I know our sales and support team get asked a lot about and we speak to a lot of people about. But today we're going to be talking about everything you need to know about bringing on a business partner, so bringing somebody into your company. Now, if you've not joined us before, so just a couple of introductions. So my name is Liam. I am your host for this webinar series, as well as Service Improvement Manager for First Formations. Prior to working in company formations, my experience is a lot in finance and consumer credit products, sales and analysis, as well as people management. And joining me today is my colleague, Campion, who is our Chartered Secretary and governance professional, as well as Associate Director with First Formations, and he heads up Linear CoSec, who is our sister brand who deals with our more complex secretarial matters. And may I say, is looking fantastic in tweed today.
Well, thank you. They said I could wear what I want today.
Lovely. Well, you're just showing me up. But jumping back to the structure of today, so like I say, we'll be running through what you need to know before bringing on a business partner. So what we'll be looking at is what we mean when we say business partner. What do we actually mean? How you can identify the right person, the right new business partner for your company, as well as deciding what position they'll take up within the company. Some key considerations to take into account regarding equity and control, as well as the process for onboarding and onboarding your new business partner, as well as settling disputes, as well as planning for exits. And as always, we will have some time for questions towards the end. Now, just a little bit of housekeeping. So we are on a Zoom call, so everyone will be muted just so you can hear us clearly. If you do have any questions, you don't have to wait till the end. Feel free to pop them in the chat function and we will get to those. Like I say, towards the end, we'll try and get through as many as we can with the time that we have. And as well, this session will be recorded. Now, if you don't know who we are, just a little bit about us here at First Formations. So we are the UK's leading company formations agent. We've helped thousands of customers incorporate over 1 million companies using our signature packages. We also offer address services as well as corporate secretarial services to manage, maintain and grow your company even after incorporation. So like I say, today we're covering everything you need to know about bringing somebody in as a business partner into your company. So I guess just to start us off, I mean, obviously you and I will have heard the term business partner used freely and interchangeably. Just to start us off and get everyone on a clear footing right from the get-go, what do we mean when we say business partner?
Certainly. So, there's no single definition when it comes to what we mean by a business partner. What we mean by a business partner in the context of this webinar, it's probably best to decide what we don't mean. What we don't mean is maybe one of these affiliate programs that often gets advertised as business partners or what have you. Those links where you put your link on, someone clicks through, they maybe purchase something out of an offer, and you maybe get a little bit of money about that from that. That's not what we mean here. Nor do we mean other companies that you might deal with on a regular basis. Oftentimes people might call key suppliers or key third parties that they often work with as business partners. So for example, if you're an online shop, then you might refer to your e-commerce platform as your business partner, which again is not really what we're looking at here today. What we're looking at here today is another person or persons, it could be more than one, a significant person or persons that you're looking to join your company. You're looking for them to join your company, probably to help drive it forward, to drive some growth. And it's not just going to be a simple employee coming along, an employee coming on for the ride. It's someone who's going to take up a significant position and probably going to get maybe a little bit more in return than the average person. That's who we're looking at today.
Lovely. And just a bit, this is going to be a generalization, but what do we mean when we're saying like business partner? What does that person look like when you're thinking about bringing someone in?
I don't think there is no one size fits all. as regards what your business partner looks like coming in. I think what you have to do if you're sitting there and you feel that need coming on is to understand or question yourself, what is that need? Why am I thinking about this? Is there a particular role or need or desire or requirement that is driving my need to look further afield to bring someone in? What role are they going to play? What skill set does this person or persons have that's so important? Does it complement my skills? Is it more of the same? Or is it maybe, are they going to be working in something very specific? Are they going to take care of everything financial about your business? You need to, I think, I don't think we should be looking at it in the sense that there's this one type of person out there and they are your partners. It's rather understanding what your need is and taking that forward and identifying the person that ticks all those boxes. Before anybody says anything, can that business partner be your family, close friends? Absolutely. I don't think there's any reason why that can't be the case. Family members, close friends are a very common source of business partners. That you can see that in the examples up and down the country and throughout history. What I would say is that maybe if that partner happens to be a close relative or a close friend, then that might add in a few additional complexities that you've got to take into account. And what I mean by that is the relational dimension, because you have a personal relationship with this person as opposed to simply a professional one, and those two might intertwine. If one of them goes wrong, then they both may go wrong. That's the sad. That's one of the realities. All relationships can go wrong. There's just that added dimension. And what I would say, generally, I think we would advise caution, as we would if you were to say, when you're thinking about going into business with everybody. But in addition to caution, don't forget we've just released the video on YouTube dedicated or specifically for tips and advice if you're thinking about going into business with friends and family. It's 5 key points. We released it the other day. You'll recognise the person presenting. Have a look at that video after this webinar's finished, of course.
Of course. And I guess a fundamental question that people are going to be asking when thinking about bringing somebody into their business, obviously this is your business, so what kind of role is this new person going to then play? Are they going to be a shareholder that takes up equity, or are they going to be a director? And we obviously went through the roles and responsibilities of a director in our last episode of the webinar series, so check that one out if you haven't already. And oftentimes, will they fill both positions? I guess, tell us about what people can expect, or tell us about the positions that the people have available to them.
Okay, we're going to look at these positions in detail in just a moment. So let me just give you a little bit of a rundown. You probably heard this. You probably heard us say this many times over. So let's just clarify again what the relationship between the directors and the shareholders are, because they're very different. In the context of smaller companies, people are they may be the same person or same persons, but for the avoidance of doubt, what you have is the shareholders, whose role is to own the business. That's it. And you've got the directors who are there to run the business, run it onto a day-to-day basis. It's a very fundamental relationship, a very fundamental part or feature of those two positions. So we'll go into that in just a moment. I just want to clarify actually, because we do have a tendency to use these words. When you hear the word equity stake or things like that in these sorts of contexts, I just want to clarify what we're talking about. It's basically someone who's going to be holding shares in whatever form. So if you hear equity stake, we're talking really about the shareholder perspective.
Definitely. And I guess, so for people that have decided, you're going to bring someone on, let's just focus on director for a second. So if you're bringing someone on, you're bringing in this new business partner as a director, give us a rundown, not just on the role, but also what are some things to consider if people are thinking of bringing on a new director?
As I say, what the directors are there to do is there to run the business on a day-to-day basis. They are the agents of the company. That's really important. And essentially, the directors are bestowed with what I can only describe as a very wide range of powers. As a general rule, the directors are some very powerful people. Where do those powers come from? They come from multiple areas. Principally, they come from, firstly, legislation. So Companies Act 2006, probably the most important piece of corporate legislation here in the UK, or at least I think the longest one. But the other key area that directors draw their power from are the Articles of Association. And the Articles of Association, if you're new to running a company, is your principal constitutional document that dictates or determines the rules and the principles on which a company is going to be run. Any person that becomes a director is operating within the confines of those Articles of Association. Anybody who becomes a director, we would always advise they should understand or be aware of chapter and verse what their own Articles of Association, what it says. Now, what does that mean in practice? Again, very wide range of powers bestowed upon the directors. I mean, the big one is probably, say, the ability to bind the company into contracts. As I said, they're acting as agents. They can sign on behalf of the company. It's a general rule. And you've got other things that you would typically expect with a director: the ability to hire people, fire people, so on and so forth. All those things that you'd normally expect a director to be able to do. So it's a huge amount of power. But on the flip side, there is a huge amount of legal responsibility that is placed onto the director in terms of running this business. And that's not just something for the person who's becoming a director to be aware of, but also you as a person. You may own a company, and if you're thinking of making somebody a director, well, we will have to consider, will this person be able to fulfill their requirements? Will they be able to keep my company on the straight and narrow, and not just in its ordinary operational elements, but also from a legalistic perspective? It's a huge amount of responsibility, and anybody should absolutely think twice about becoming a director, just in the same way you should be thinking about twice for anybody you're making a director. Just before I move on, just as a quick reminder, that what I've just described is an enormous topic in its own right. We could have series on this topic alone of what the duties and the responsibilities of the directors are and their powers. Just FYI, if you didn't see the last webinar episode that we put in place, we dedicated about an hour to talk about the roles and the responsibilities of the directors. So if you haven't seen that already, it is available on YouTube. So absolutely give that one a watch to give you a bit of an idea of just some of the expectations that are placed upon the director. Now, so that's the role. I think that probably is the most concise I can place or detail what the position of the director is. Now, just starting to think a little bit further forward about the considerations you need to take into account. The big thing here is, many people have been operating as a sole director, the only director appointed in a company, so their word is the law. They say something, decision is made. It's easy. When you start adding other people in, and this is going to become even more obvious as we go through this webinar today, when you start adding other people as directors, well, they're joining a board. We call it the board, which is the term we use to describe all of the directors together. And that's really important because the board of directors acts as a general principle on a collective basis. And what that means is that decisions are made on a majority basis, which means more than half of the directors need to approve a decision for it to go through. In normal cases, there are exceptions. Sometimes that bar is a little bit higher. But that's, you can probably already see where I'm sort of going here. For a decision to be made, for the directors to make a decision, they need to have a majority opinion in favour. Every director, as a general rule, has one vote. We're equal. So if you and I, if things got really bad and you and I set up a company together and we were both directors, if you think about the maths, there's two of us. The only way we could hit that greater than 50% 50% plus one, we call it. The only way we could hit that is if both you and I agreed on a decision. So if you bring someone else on, your business partner, and you've made them a director, suddenly you've gone maybe from a position of being the only director, your word is the law, suddenly you've got another fella, or a man or a woman. And if there's only two of you, it stands to reason the only way you're going to get something through is both of you agreeing. It's really important. We're going to keep coming back to onto that basis in due course.
Absolutely, yeah. And I guess in that case, if you're thinking about it, and obviously votes then become quite important, as we'll see as we go through. But is it absolutely necessary for someone to then come on as a director?
That is entirely dependent on the circumstances, and I'm going to apologise in advance. I'm going to be saying that a lot today. It's always contextually dependent. I'm not trying to avoid the question here, but whether you absolutely have to make someone a statutory director or not is entirely dependent on what they want and maybe perhaps what you want. Now, let's just clarify firstly what we mean by a statutory director. What we mean by a statutory director, and I think we're going to look into how we become one, we mean an officially appointed director on the company, someone who's listed on the register of directors who you can see on Companies House. That is the position we're generally talking about. But maybe, because as I said, it's a huge amount of responsibility to place on someone. There's a huge amount of responsibility for your own company to give somebody else to potentially cause some of the issues that we've only just touched upon here. So, I can absolutely understand a lot of people saying, well, hang on a minute, maybe I don't want them to be a director. That sounds like that could be a whole lot of issues. I could lose a great deal of control out of my company. I completely understand that. There are alternatives. I mean, number one, you might use that as a goal to move forward to. If you're looking to bring on someone, you might bring them on into a senior position and say, look, in due course, if this works out, I'll make you an official director. The other thing I would say is that it is possible to call somebody or give someone a job title which uses the term director. Why do people do that? And give them the job title of director without actually making them a statutory director. That is actually possible. I mean, for example, myself, I'm an associate director here. You won't find my name under the list of directors if you look on Companies House. Why do we do that? Well, this happens particularly in large firms. This happens a lot in large firms because the word director, the name director, denotes a level of seniority. So oftentimes people, when they take up a position in a company, maybe if they're employed, they may be called a director, but you will find that actually they're not a statutory director. They're not listed on the register of directors, which you can then see on Companies House. That's something that you might consider as an alternative. Give that level of seniority without actually giving them the full whack. Or maybe you might just call them a director in terms of seniority to begin with, and maybe in the future you might make them a statutory director as well. Absolutely, I think something that is reasonable. I will just clarify for any persons inclined to read up on the legal aspects of this. As I said, it is perfectly legitimate to call someone a director. Mm-hmm. Again, from a job title perspective, and not have them listed on Companies House. Again, that they aren't a statutory director, and that's perfect. That should be fine. There is a part of, there is an area of law, an area of corporate law, which says that actually, if you call yourself a director and you act like a director, then even if you aren't an official one, the fact that you are acting one as presenting as one may mean that you do become subject to the duties of being a director, right? So you may be viewed under the eyes of the law as frankly being a director. It's called being a shadow director. You're not actually officially listed, but you are. That's a very complex area of legislation I'm not going into. I only say that just to clarify, look, it's not a carte blanche. You can't just call everyone the director and they can all be a director, everything but actually being appointed. There are consequences sometimes to that, but as a general principle, calling somebody a director as part of a job title, perfectly reasonable.
Nice. Well, I guess that is good a time as any to bring us into, the process and how do you go about bringing somebody new into your company as a company director?
Okay, I'll talk you through the company secretarial process, which I have to preface, as always, it depends on the company. Procedures, processes differ whichever entity from company to company. That stands to reason. I'll tell you what most companies go through, what most small companies do so. So you want to make a person a director, it's actually pretty easy to do so. Usually, obviously, you're going to have to check your articles of association for certain procedures that, bespoke procedures that you might have to go through. But let's just presume it's a completely vanilla company, uses the model articles or maybe our own standard articles or something like that. In which case, the process starts with the person in question signing what's called a letter of consent to act, which is basically a letter saying, number one, I want to be a director. They are willing to act as a director. And number two, that there is nothing that prevents them from doing so. What do I mean, nothing preventing them from doing so? I mean, I meet the minimum age requirements. I have to be at least 16 here in the UK. I'm not an undischarged bankrupt. I'm not prevented by any order of the court. Although there's nothing that the courts have decided that meant I can't act as a director. I signed that letter for Liam Limited, and I say I'd love to be a director, right? That letter gets sent to the company, and the company then needs to make the decision, will they appoint them or not? Where does that power come from to make that appointment? Well, in general terms, it's the shareholders who have the power to make someone a director. So the shareholders might pass an ordinary resolution of the company, right? And that would be the decision, and that's what makes them a director. I will say that oftentimes, from a procedural perspective, it's actually the directors that make that decision. Most articles do provide a level of authority for the directors to appoint other directors. So things like the model articles, it says, by a decision of the directors, they can stick that in. So regardless of whether it's the shareholders or alternatively, if the directors then have to make a decision, either at a board meeting or by a written board resolution, the company needs to make that decision. Again, doesn't matter. For this purpose here, it doesn't really matter who makes that decision. You got your letter of consent, I want to act as a director. You give it to the company. The company decides, all right, I would like to make you a director. And the relevant persons make the decision to appoint you. Next up, enter into your register of directors. Your register of directors, something that all companies need to be maintaining. It's that book which basically says, here's who our directors are. This is the law. This is who runs us. And once it's been entered into the register of directors, you submit it off to Companies House, and you've got to do that within 14 days. It's quite a tight deadline. You get that onto Companies House, they're visible, everybody can see it. That is the general process if we're talking about making a person a director. I would say that other considerations include, well, let's put a director service agreement in place, or an employment contract, depending on the context. And you'll probably do that before or as an integrated part of that procedure that I've gone through. But as I say, it's a pretty standard way of onboarding someone as a director, fairly simple. They want to act, you've got all your ducks in a row, maybe get that contract in place, make the decision, whoever it is, get it in your books, get it sent to Companies House. And you've got a person who's now acting as a statutory director for your company.
Easy. Now, if you do find that you're wanting to bring somebody in as a director, we actually offer a director appointment service, $29.99 plus VAT, and our team will handle your appointment letter, your resolutions, and that filing with Companies House. So if you do find yourself in the position where you're thinking this is the right decision for me and my company, and you're wanting to bring someone in, give our team a call, and we'll be happy to help you out with that. Now, so I guess that covers bringing somebody on as a director. What do we do when the shareholders are involved? So if we're wanting to bring somebody in as a shareholder, and what consideration should be taken in that regard? Okay,
well, again, let's just go through the shareholders very quickly. As I said a little bit earlier, the best way to look at that is simply, all right, these are the guys, the men or the women who own the company. What responsibilities do they have, shareholders? Actually, they don't really have that many. And you could probably describe it really as two. I think it's actually more one with a very tenuous number two, and you'll see why in a second. The first one, shareholders provide, to some degree, financial backing for the company. What do I mean by financial backing? That is related to the liability that they incur when they take on the shares in the company. Generally speaking, when you take on shares, you agree to take on a certain level of liability. It's usually it's usually the unpaid amounts on the nominal value of the shares. So if it's £1, nothing's been paid up, and you say, I'd like a share, okay, you can have a share. You'll either pay the £1 or agree to pay it in the future if needs be, plus any premium on top. Your liability extends to whatever you agreed to take on when you took up that share. Of course, if you fully pay it up, that liability goes, and you may actually receive shares which are already fully paid, in which case you actually have very little liability. That's probably the key thing. Remember, the clue's in the name. We call it a limited company, don't we? The limited refers to the limited liability, which is what I've just talked about. It's the onus that's on the shareholders to pay up the shares if and when they are required. But say for that, generally speaking, there is not much more that's required of them. The key responsibility here is to make decisions. It's to make the directors make decisions for the day-to-day running of the business, but that's only within the confines of what they're allowed to, of the powers that they are provided. Sometimes these decisions are something that have to go to the shareholders. For example, approving a director loan above £10,000. That's one that the directors just can't do themselves. If it's under 10,000, I think normally you can get away with it. But greater than £10,000, you've got to go to the shareholders and say, we need to loan this director X amount. And that's really, there's no requirement for them to vote, but generally speaking, that the onus for them to make those decisions is on the part of the shareholders. As I say, I gave the example of the director's loan. There are other ones, I guess in some respects you might see it as small decisions on the part of the shareholders, which is, should we change the company name? That's often something for the shareholders to decide. Or should we make a very big decision like change the constitution of the company? Change the foundations, or the foundation of the constitution of our company, a big decision. And depending on the type of decision that the shareholders are making will depend on the type of resolution that they have to pass. There's two types of resolutions that shareholders can pass. They are called ordinary resolutions and they are called special resolutions. The ordinary resolution, what that is basically a decision. It's usually what we call the normal shareholder decisions. It basically needs greater than 50% of the eligible votes cast in favour of a decision. 50% plus one, as we, like with the directors. The other type, special resolution, that's reserved for the big things like the change to the Articles of Association that has a higher threshold of greater than 75%. Remember these percentages because these are going to become important when you're trying to bring on a partner, right? Just let's make a note of that for the moment. So as I said, two key roles, or I guess responsibilities that a shareholder has. Number one, provide the financial backing, or to some extent the financial backing. And number two, make certain decisions. Other than that, as I say, there is not normally much placed on the backs of shareholders. And what it's really about is their enjoyment of the rights of being a shareholder, their rights to participate in dividends or capital distributions or things like that. So really, I guess when we're thinking about shareholders, it's more almost like particularly in the context of a business partner, we're almost looking like we're from the perspective of incentivizing someone rather than necessarily the responsibility that we chuck onto them. Of course, then, if we're going to talk about giving them shares, obviously the next question that comes up is how many shares do we give them?
Definitely, and I guess that is going to be the big important question, isn't it? Generally speaking, if you are thinking of bringing someone on as a shareholder and you're giving up a part of your company to this new person, how many shares do you give them?
It's context dependent, I'm sorry.
Yeah.
It's going to be based on a multitude of factors, what you need from them, what they want, what part of the story you're at. And actually probably the story is the important thing. Firstly, where have you come from? What have you gone through already? Generally speaking, when you're looking to bring on a business partner, you might have already set the company up. You may have gone through the first maybe 2 years, set the foundations, started the company on its trajectory of growth. So I've got to figure that into account when I start giving away some of my company to some other person. Bring on my business partner, or hang on a minute, some of this was what I did, not necessarily you.
Absolutely.
Yeah, I'll describe what you can do there. But to talk about it from a more procedural perspective, how many shares do you give? Well, the shares that you give is dependent on the percentage of your company that you're seeking to give away. And that's the key thing, percentage. It doesn't matter how many shares, from a number perspective you give someone. Well, it does, but the actual true number that you're interested in is the number of shares that you give them versus the number of shares actually in issue. In other words, the percentage of shares that they're receiving. So it doesn't matter if they are given 30 shares in a company with 100 shares, 30%, or they're given 3 shares in a company of 10 shares. Still 30%. It doesn't matter how we got to it. So maybe the first fundamental question is, how much am I actually wanting to give away? Now, let's start talking about some considerations here. Now we're getting a little bit of an idea as to how much I want to give my partner. First and foremost, let's just go back those types of resolutions. There's 2 thresholds that are really important. Ordinary resolution, 50% plus 1, it needs to get passed. Special resolution, 75%. That means if you give someone 25% or more in your company, you will not be able to pass a special resolution without their consent, without their unanimous approval. So you and I put together a company. You get the lion's share, 70% of the exactly, yes, and I get the pilly old 30. But hang on a minute. Now Liam can't make these big, massive shareholder decisions without my approval, because I've got 30%. That means I can block a special resolution. There are still things that you can do. You can still make some of those common shareholder decisions that require only an ordinary resolution, which again, greater than 50% or 50% plus 1 that we take that we were looking at, but I can block those big ones. Okay, so that's the first consideration you want to take into account. Yeah, those thresholds. Let me start muddying the waters up. Okay. How many shares? Maybe I can sort of, separate necessarily the number of shares I give or you give me and the actual control I get. And when I mean control, we're often talking about the voting rights. How can you do that? Well, you can do that by introducing different classes of shares. And probably the most common way of doing this is through alphabet shares, which we see a lot when people bring on a partner. Maybe it's a bit of unequal footing. Well, let's talk about different classes of shares. Alphabet shares are the most common. It's just ordinary shares, which are varied on dividend voting and capital distribution means. Usually they're then called the A ordinary, B ordinary, C ordinary. It's just sequentially done. That's where the word alphabet shares comes from. So the beauty of, say, alphabet shares is that we can start enhancing the voting rights that we were looking at. So we might say that Liam and his 70 shares, we'll call them 70A shares, and I get 30B shares. I'm happy with that. But actually, you've given me the B ordinary shares will get 1 vote per share, as is very standard. But actually, you're going to have, through the magic of alphabet shares, you're going to get enhanced voting rights of 3 votes per share. Very common. What is that effect? The beauty is, let's just say we have equal dividend rights. I still get my 30% of the dividends that are declared. But you retain a lot of that power, because if you've got 3 votes for every share held, you compare that with the 30 shares that I have, which is just 1 vote per share, suddenly you've got 90% of the voting power versus my own. So you get a bit more flexibility there, don't you? Suddenly we're not so tied to that. How many shares, what's the percentage of shares that you hold, and that equates to the control. You can sort of separate those 2 out and still give your shares out, but still retain control. And that's something that, if you started that company, particularly if, as I said, if you've gone through a bit of that journey already, you've gone through maybe the startup cost, you got a bit of funding, maybe you've got some lending, or you had an investor come on board. The beauty is, great, I've done a lot of this. I do want to keep a bit of control. I'm sorry, Nick. I'm talking on your behalf. I know.
Go for it.
Yeah, I know I don't sound like you, but
a little bit.
But yeah, at least you can keep that little bit of control there.
Yeah.
And of course, you can also vary other rights associated with those alphabet shares. We can do variable dividend rights, which basically means that Well, in the normal cases, every share has to be paid the same rate of dividend, right? Equal rights to a dividend. Doesn't matter how many shares you have. Every share that you have is paid the same amount. And then the amount of dividend you get is just depending on how many shares you have. But if we then introduce variable rights, again, maybe Liam did start the company. He only wants to give me 30% of the company with 30% of the votes, but he's feeling particularly generous today. And he decides, you know what, we put variable dividend rights into the A and the B shares, and actually, even though you have only 30% of the shares, I'm going to give you more than 30% of the dividends. We're looking at the incentivization element of this again.
Absolutely.
Brilliant. Okay, so we're not tied down to this equal element. I think there's two final things. I know I'm sort of powering on to lots of different things, and I'm going to muddy the waters just a little bit more before we move on, because we've talked about, all right, let's just look at it from a simple, hard, mathematical perspective. How many shares are you getting? And then that's going to equate to my control and my enjoyment. Then we looked at how we muddy the waters by maybe separating out necessarily the percentage of shares I have to the actual enjoyment of the rights. Let me just bring up another consideration, which is, it is another class of shares, but it's a particularly special type of class of shares, and that is growth shares. You may well have heard of these. I certainly think they are becoming more and more popular. Growth shares are something that a lot of companies are giving to senior persons, and I think it would probably be relevant or appropriate in the context of this webinar to say people are bringing on their partners, oftentimes bring them on the basis of giving them growth shares. So what does that mean? What do the growth shares do? I'll just explain the very basic premise. I'm sorry if you've come across these already. But basically, it's another class of shares. And what the growth shares do, it ring fences the value of the company up to a certain amount of your choosing. And it says you're not going to enjoy, I'll give you some shares, but you're not going to enjoy any of the growth of the company until it gets over a certain level. We call that level the hurdle. The hurdle is usually above, is usually what you've built already plus a little bit. Usually say, all right, this is the amount, this is the ring fence amount plus a little bit, maybe 10% or something like that. And any growth on top of that, that's what you'll enjoy. If the company gets sold later down the line, yeah, you'll get to participate in the sale, you'll get some money, but it will be based on the growth that you helped create, not the stuff that you did, Liam. Way back, you put in all those hours, you built a company, say it's £900,000 worth, a valuation of £900,000. You did that. Why would you want to give me that? I mean, please do, but not. I guess you probably wouldn't want to do that. So you built your company. It's valued £900,000. Let's call the hurdle 1 million, right? Let's call it a nice even million, and then I only participate, or I only start enjoying once we grow beyond that. And maybe when the sale comes down later down the line, I get a little bit of that. So that's probably really quite. I started fielding a lot of these queries, it seems, maybe about 3 years ago now. It's certainly becoming more and more popular, and I'm aware a lot of big firms do this as well in terms of incentivizing their senior hires, certainly in the context of business partners. I think it's very relevant. And then finally, as a final point, if you're bringing on a business partner, do you have to do it all at once? Can you stagger the shares being given to them? I think that could be very relevant. It could be something to work to.
Definitely, and it's good to see, whether we're talking about non-statutory directors or these different classes of shares or even staggering shares, how you can tailor the options depending on what you require for your business and bringing somebody on. So I guess we've looked at directors, so let's then look at the process for bringing on a shareholder and how does that look?
It's a little bit more complicated, if that's the right word, than bringing on a director. There's 3 ways to become a shareholder. I mean, number one, and I didn't say this for the directors, but it is appropriate for the directors as well. It could be simply that you were listed at incorporation as a shareholder with the relevant number of shares. So you're just a shareholder from the off, job done, you've got a bit of the company. But let's just say the likelihood is, and many of you at home will probably be in this position, you've already formed the company. Maybe you've even been around for a little while. You built something up. So how do we get people on as a shareholder from there. There's basically two ways of doing this. Number one is through an issuance of shares, and number two is through a transfer of shares. What a transfer of shares is very simple. You can probably work this out. It's moving, transferring, or selling some of the shares that you hold over to me. Maybe I'll do that for a price, maybe I won't. But the important point is the number of shares, the amount of share capital in the company, the number of shares stays the same. It just means that some of that proportion is moved across to me. Issue of shares is slightly different. It is the creation of new shares that didn't exist before and applying them directly to me. Now, which one you go for in terms of bringing someone on board, I'm afraid that is context dependent. It's dependent on a few things. It's dependent on whether the person is going to be buying these shares from the off. It's dependent on tax implications. Certainly if you're transferring shares, and this isn't the purpose of the seminar, we can't give tax advice, but maybe the transfer may be something like capital gains tax that you might incur. Every single situation is different, and you need to have your accountant as part of this process. So there's two ways. The effect is still the same. You normally get the same amount in the hands of the other person, in my hands. Maybe it's just a different route. They're not administrative. From an administrative perspective, the burden is probably roughly the same between the two, give or take a few extra pieces of paper, but the effect is still the same.
Okay. And I guess then, not to sound pessimistic, but we have kind of reached that point of the webinar. So let's just quickly pretend we live in reality and discuss why it is...
want to do that.
No. But let's discuss the reasons why it is important to plan for exits and disputes without being too pessimistic.
Okay. I think disputes and exits often get lumped in together. And I understand that. I think for our purposes, it's probably easiest to look at them as two probably mutually exclusive things. It's not. This is just for simplicity purposes. We just don't have time to go into this. So, what is an exit? Exit is a shareholder or shareholders leaving a company, right? Why is it good to plan for that happening? Why is it good if you're bringing on a business partner before anything's even started, before they're even on board, start saying, right, how are we going to get rid of you? Or how are we going to get rid of us? It's a bit pessimistic, it's a bit depressing. We haven't even started the fun, and we're talking about getting you out of here. There's various benefits to doing so. I think the first one is probably an incentive perspective. It gives the person something to aim for. The exit might be based on certain conditions being met. It gives them a bit of transparency. It gives you a bit of transparency as well. So, you both know where the exit doors are. I know I've just explained exit as meaning an exit, but you both know where you're going to go, and if whatever happens, this is how we're going to part ways, be it on good terms or maybe lesser good terms. That, I think, is probably why it's important to start planning for exits, even though you haven't yet begun the fun, as I say. Now, disputes, what we mean by disputes is disagreements within the company. And, of course, that's always going to happen. I think when people talk about disputes, usually they are thinking in the context of shareholders. Directors can be in dispute, they may be in disagreement, and oftentimes it goes to the directors. I would say that, certainly if you read online, most of the people are talking about, well, if there's a dispute, we're talking from a shareholder perspective. Why are disputes so problematic? Well, the issue is, particularly for certain companies, not all of them, but again, context dependent, disputes can lead to deadlock. If you and I were both Liam Limited that we talked about earlier, and you and I were both equal shareholders, equal directors, well, we couldn't get, as directors, we couldn't get something through. We both needed to agree on something. It was simple mathematics. Same again with the shareholders. I can't even get an ordinary resolution out. Liam can't get an ordinary resolution passed, even though he formed the company. It was his company. And why is deadlock so problematic? Well, firstly, from a commercial perspective, this leads to paralysis. It leads to the company being unable to make decisions. It can't move forward. And if it can't move forward, well, that could be fatal. Often is. That's one way of dealing with the deadlock. Can't be in dispute if you haven't got a company. It goes under. That's not a foolproof plan. Don't use that one. But so your dispute might turn into deadlock. Might paralyze the company. Commercially, it could be ruinous. Reputationally, if people hear about what's happening, these guys can't agree on anything. Problematic. And even the banks, if they hear what's taking place, they may freeze your account. If they get wind that these guys can't get on, they're in complete disagreement, they're in deadlock, well, hang on a minute. How do we know that you have the ability to take that money out? How do we know you have the permission to be doing what you're doing with the account? Freeze the account, get your house in order, then come back to us. That in its own right could then, again, be hugely problematic. You brought this partner on to help things, to help grow, but suddenly you're finding yourself in paralysis and unable to do anything. Not a great position to be in. Mm-mm. So really problematic and really important to avoid it, but if you can't avoid it, then at least have an exit route. Maybe I shouldn't have used the exit route, but a way out of that deadlock. And why does this happen? Why do many companies find themselves in this position? Well, firstly, maybe it's because that's just how they've been set up. When you're talking to somebody, your business partner, oftentimes it seems fair. Okay, look, we'll start a new venture, you and me, 50-50. Sounds very equitable. It sounds very nice. But from a procedural perspective, that alone could lead you into a great deal of issues. And and this can come out in so many different ways. It can come out in just simple breakdown of personal relations. It's not just commercial decisions that might happen, but your personal relationship might collapse and suddenly your personal issues play out as professional problems within your company. The business partner that you may have gotten on very well with suddenly decides, I'm just going to lay in front of the tracks, make sure if I can't move, do what I want, then nobody can. And that's probably very applicable if you're going into business with friends and family. I can't tell you, and this is just anecdotal, I can't tell you the amount of people that come up to me and the first thing, and I take no joy in this, but the first thing that they might say is, I've fallen out with my business partner. Turns out the business partner was a significant other, maybe a girlfriend, a husband, boyfriend, what have you, a close childhood friend, and things just haven't worked out, and suddenly that personal, might not be just personal, but that personal problem has now played out in paralysing the company, setting it into deadlock, or maybe they've just got no idea, no way of agreeing how to move forward.
Mm-hmm. Definitely, and obviously something that people want to avoid at all costs.
Yeah.
But I guess looking at people exiting in the company, can you give us examples? How can we plan to have someone exit? How can you make a plan for an exit?
I think, so again, exits tend to be, oftentimes the juicy side of exits is what we're talking about when the exit is being an IPO or a sale, maybe to private equity firm. That's becoming such a massive thing. It has become such a massive thing. It seems to only get bigger. And there's things that you can do for that. But I guess in the context of maybe at this early stage and talking about a business partner, you're talking about how is that person going to leave the company? Well, generally speaking, there's two ways a person leaves a company. There are other ways, but the two key ones is that they sell or give their shares to the remaining shareholder or shareholders, or they sell the shares back to the company. That sale back to the company takes place through what's called the purchase of own shares. In those cases, the company itself usually pays the shareholder for their shares. The shares are given to the company It's one of the few situations where a company can own its shares in itself, and it's subject to a lot of restrictions, including how you might fund that purchase. And then the company will then have an option either to hold them in treasury, which is to hold shares in itself, depending on what it decides to do in the future, maybe give them to somebody else from there. Or it can simply cancel the shares from there on out so that the shares no longer form a part of the share capital. It's an easy way of getting a person out of the business. That's an exit for the shareholder in question. Now, how you plan for that is probably through a shareholder agreement, which is usually put in place before they become a shareholder, and that might set the conditions through which that exit might take place. That exit might take place, dependent on, say, certain timescales. It might say, okay, look, in 3 years' time, I'll buy the shares back from you. You might agree a certain price for that. It could be based on performance. Performance on an individual basis or performance on a company basis. And you can also set different conditions or different payouts, shall we say, dependent on how things go. It's not just a case of if this happens, you'll get this amount. Well, actually, could we say if A happens, then you'll get this. If B happens, you'll get that, so on and so forth. The best way I can describe, I don't know if it's properly relevant to business partners, but I'm going to say it anyway for illustrative purposes. Good leaver, bad leaver provisions. That's something that you might have heard of a few times before. Good leaver, bad leaver provisions. It's oftentimes linked to employment within the company, and it says basically that when a person leaves, or dependent on how that person leaves the company, will determine what's paid back for the shares. The shares are usually redeemed or taken back by the company. And it might say if you leave on what it defines as good terms, which can be a lot of things. It could be that they resign or that they were made redundant. Sometimes things just play out that way. Redundancy is not necessarily a bad word that is a mark, a suggestion of your performance. And if it's a good leaver, then you get X amount for your shares, maybe thrice what you paid for them originally. Versus if you're a bad leaver, let's just say, for example, you fired your business partner, they were an employee and you fired them, then actually in that case, we're just going to give you back what you paid. Nothing else. Nothing gained out of that. Again, I don't know how relevant good leaver, bad leaver provisions are specifically to business partners, but I think that's a good illustration of, the ways you can plan for the exit, and it maybe probably be in the shareholder agreement or maybe a mix of the shareholder agreement and the articles of association itself, and it determines not just how the person is going to leave, but also what they get in return.
Definitely. Now, just to touch back on it, because you mentioned this briefly, we were talking about deadlock. Now, obviously that's something everyone's going to want to avoid, but how can we go about preventing, or if you do find yourself in the position, breaking that deadlock, and how do we get back to a position where you can make decisions?
Okay, there's two questions here. Number one, how do you prevent it? And number two, how do you get out of it? So preventing it is probably just a question of maths. Liam Limited, do you remember that one where you made me a 50% shareholder and another director as well? Well, you wouldn't do that. Maybe you don't do that. Maybe that original 30%, at least you can get an ordinary resolution through. It's a question of mathematics. But let's just say it does happen. Let's just say, well, look, whatever the situation is, this is how we got to it. One way of preventing or unblocking deadlock, should it occur, is through what are called deadlock provisions. And these are usually put into these shareholder agreements. And I won't go through all the different types because there are many. And they got some great names, these deadlock provisions. I won't go into all of them, but the essence of these deadlock provisions is that one of the persons is bought out, i.e. they exit out of the company. Again, I probably shouldn't use the word exit. I don't want to confuse it with a more standard exit, but the person leaves the company. That's the goal here. Break the deadlock, well, get rid of the problem, which is the other person or one of the persons. If there's only one person left, they can't have a problem with themselves. So, for example, I think it's called a Mexican shootout, and again, these are fantastic names. They're not nearly as exciting as the name suggests. But in the Mexican shootout clause, what you have is, the shareholders in question put in the bid, the lowest amount that they're willing to pay. I think it's the lowest amount that they're willing to pay for the other person's shares. And then it's drawn out. This is done on a sort of a blind basis. And then at the end, these prices are drawn out, and if you then have to pay, if you have the lowest amount, you must pay the highest amount that was put in, that minimum amount. I've explained it horribly. I won't go into details, but it basically incentivizes you to value the company fairly, lest you shoot yourself in the foot. And the basic says, all right, I agree now. I have to pay that highest amount. That means I'll buy that other person out, and therefore, the deadlock will go away because the person I was disagreeing that was called, the deadlock that was arising is now gone. The deadlock's gone. We can carry on. So that's our way of doing it, but I'm afraid that's how it is. And there are other solutions. Actually, I probably group these together a little bit incorrectly, but I talked about maths being a problem. It's a question of maths. Well, if there's only two of us, how are we going to deal with that? Well, we talked about the weighted voting rights and so forth, but there are other people you can call on. Maybe you want to call on somebody else to act, maybe as a director, to make it a 3-director company. I know sometimes accountants will be appointed as a director, or indeed just take up a share that may not have any other rights associated with it, but at least with that person, there's sort of not an arbiter, that's the wrong person, but it just makes sure that there's always a swing vote. It's like the US Supreme Court, I think, there's an odd number of justices so that deadlock doesn't happen, except of course when they have less than the 9. I think they got 9 justices. When they have less than that, then that doesn't really work. They've got to have all of them together. So you've got creative solutions like that. Just as a final note, I think this is a bit scattershot, but I did want to talk about, because we talked a lot about if you're in dispute with your business partner in the perspective of a shareholder. Let's just remind ourselves, what about if the position of the director is a problem? They're not even a shareholder; it's the director. If we're talking about director issues, then deadlock might be broken if someone were to leave as director, and if neither wants to go, then you might seek to remove a director. Removing a director is fairly difficult under the Companies Act, probably deliberately so. The only real way you can do it, unless you have special provisions already in place, is through a Section 168 removal. And what 168 says, this is Section 168 of the Companies Act, it basically says if you want to remove a person, you have to do it via ordinary resolution, 50% plus 1. You have to do it via ordinary resolution, and you've got to do it at a general meeting. And the general meeting has to have a special amount of notice, an extra amount of notice. So you can't just do this on the fly quickly. It usually takes about a month to do. And at this general meeting, the director needs to be given time to defend himself, maybe to the other shareholders, if there are any. That's really the only way that you can get rid of a director. So maybe in terms of preventing deadlock, might be actually putting in clauses within your company's articles of association which provide an easier route to getting this person off of the company. If all else fails, Liam, you don't have the provisions, or maybe provisions aren't appropriate. You can go to court. I think I've seen it described as the nuclear option, and I probably happen to agree with that assessment. The court might decide a whole load of things, up to and including, right, you guys can't get on, wind up the company, forcibly winding up the company, you take the assets which are yours, or distribute the assets fairly, company's gone. Yeah. Can't have any disputes if the company's gone, as I said. But I guess that's something most people would want to avoid.
Absolutely. Okay, so I guess that brings us to the questions part of the webinar. So we'll go through some questions, and as always, we've had quite a few come through. So like I say, if we don't get to all of the questions today, don't worry, our team will reach out to you by email to get answers across to you. But like I say, we will try and get through as many as we can today. Now, so we've got one here from, anonymous, but here we go. We've got, how about advisors? What will be a healthy way to bring them into the business? Would it be shares or some other kind of route?
Advisors, I mean, I guess there's multiple ways of doing this. I mean, firstly, I guess the first thing that we could talk about is like what I talked about, the account, maybe bringing on an accountant, maybe giving them a share or giving them a position on the board. Maybe with the shares they might have reduced, right, should we say? It's difficult with advisors because, maybe if they're an advisor, maybe you don't want to make them a director, in which case you might make them an advisor to the director. I'm not really sure how that would work, Liam. Yeah. I think what I said earlier about maybe, I mean, if it is what it is, then adding them as a shareholder with maybe reduced rights or fewer rights, or giving them a path. I mean, if they start as an advisor, maybe it's moving into a path where they become a proper shareholder or a proper part of the company. I mean, it depends on the situation. It depends on what you want to get out of the advisor. I don't think there's a very easy answer, a very straight answer I can give to that one. I'm sorry.
No worries. Now this one we pretty much have answered, but I'll just get you to confirm that we have kind of touched on this with the Alphabet and growth share options. But we've got, I would like to know about how share options work. Creating shares or share options, even equity for really significant members of staff to motivate good staff. I'm not sure if this counts as a business partner, but is important. I currently have one share in my business and I am the only shareholder.
Okay. Look, share options are different. They're sort of a different ballpark, and it could be relevant to a business partner. I actually agree that there are some very good reasons why you might do so. The thing about share options, there's a lot of schemes out there. There are a lot of schemes out there, many of which are approved by HMRC, and the fact that they're approved by HMRC also enables certain tax advantages. I mean, the big one that people use is EMI. The EMI is probably one of the more generous ones in terms of what you can give your your persons. You might give them options, and they can exercise them after a certain amount of time if they are. If they remain with the company, or then it later gets sold, and then they get to participate in that sale. So there's a lot of options out there. I mean, for example, we put in place a CSOP, a company share option scheme, slightly different than the EMI. The EMI is, you have to be a business. You can't be certain types of businesses, like accountants. I think the accounting industry is prohibited from using EMI. They've got their own things. CSOP is available. Share incentive plans are available. I think that's a whole world in its own right. But I would completely agree that just because we're talking about a business partner, and maybe we've been talking about a significant person, but there's no reason why you can put an option scheme in place to tie people in. Say, you're not going to get anything immediately. I mean, why would you want to give something immediately? Sometimes that's just not something that you might feel appropriate. All right. Take the CSOP scheme, for example. Look, we're just going to say we're going to agree evaluation. This is what happens in the CSOP scheme. You agree evaluation with HMRC. They say, okay, your company's worth this amount, I'll call it £1 million, and you grant options to certain individuals. Those options then can only be exercised after at least 3 years, and they have to be exercised within 10 years. But the thing is, when they do come to exercising them, they purchase it at the amount the amount that was originally agreed back with HMRC. There's further tax advantages to that as well. That's a great way of not immediately giving away your equity in your company, but also in an efficient manner getting shares across to people. It's actually quite difficult to give anybody shares. When we talked about how do we give people shares, transfers, issues, or what have you, I told you that you need to do that with your accountants. Very good reasons why. Tax will always come into this. CSOP schemes, these sorts of schemes are very useful at doing this in the most tax efficient manner, in the least financially burdensome manner for your shareholders, or shareholders to be, I should say. Your question is, you actually asked another question. So again, just to clarify, and I've gone on a little bit, I personally would see a business partner, depending on the context, also being appropriate to maybe give shares through an option scheme. In answer to your question about I've only got one share of £1, that probably will need to change. If you only got one share in £1, then if I issue one share to this other person or give them option over, it's not they're going to end up with 50% of my company. So maybe you want to think about increasing the number of shares that you have. So you might subdivide the shares into a much larger amount. Subdivision basically just means chopping up the shares. So you don't actually have to put any more money in. You don't actually have to issue any more shares to yourself. You just take the shares that you already got, you chop them up, you get more shares in return. I mean, on the opposite side, the normal value decreases. Yeah. So if you go from one share of £1, I can chop them up into 100 shares of 1 penny each. There's no capital lost. But that does mean that I can grant more options. You could chop them up into 1 million, 10 million, 1 billion I saw the other day.
Yeah.
Of course, you can issue more shares if you like, if that's the way you go about it. But you would need to get your capital in order beforehand, increase the number of shares that you have beforehand, and that gives you more flexibility in terms of how many shares you can give options over, and also that you can also provide smaller percentages rather than giving these big chunks out all in one go.
Definitely. And I guess this one we did touch on, but I'm going to ask again just in case there's anything you wanted to add. But we've got, would you recommend attaching different rights to a new partner's shares? And this comes from Hannah in London. I guess, again, this is going to come down to context and I guess doing due diligence. But is there anything you wanted to add about, should you give different rights?
Again, entirely depends on the context in question. We talked about earlier, Liam Limited, that you've been building up. Well, do I really want to give all of these shares, which is going to basically put this person on an equal footing as me? Yeah. Is that appropriate? If I was setting up a company, I was taking it maybe from a more selfish perspective. I can completely understand if I was thinking, well, hang on a minute, I want to give you rights maybe that aren't as great as mine. Alternatively, that might be in your particular situation. Maybe you really want this person, and they're going to come at a price. Maybe you won't be able to do that. Maybe you won't be able to cut the amount of rights. Maybe you can give them a small amount, but on the basis of enhanced rights. We talked about enhanced voting rights.
Yep.
I think that's dependent on the type of person that you want to bring in. I would absolutely, where possible, make use of the variation of the rights. I think that's a completely appropriate manner. But that depends on who you're looking to bring in, why you're looking to bring in, and what you want to get out of them.
Absolutely. And again, we touched on this one, but Ash in Torquay, how would you recommend allocating shares if I'm currently the sole shareholder but want to bring somebody in? Now, Ash wants to remain in control and currently has one share worth £1. We touched on subdivision. Yeah. Would there be any other options available to Ash?
Subdivision is probably one of the main ways that you would carry that out. The other option is simply to issue more shares in the company. So, again, and this is completely out with any tax advice or anything like that, which I'm afraid we just can't give legal advice, tax advice. But whatever happens, I think you're going to have to increase your share capital. Otherwise, your one shares represents the entire 100% of the company.
Yeah.
So how do you get more shares? You either subdivide them or you issue. Okay. You issue more shares into the company. Now, if you issue more shares into the company, well, the other dimension is maybe you're going to have to pay up for the shares right from the off.
Yeah.
Maybe that's fine. Or maybe you have something in the articles that says you're allowed to defer payment for those shares to a later point. How exactly, I think this was the question, correct me if I'm wrong, Liam, but how exactly you go about doing that, again, will depend on, do I have the money to be able to issue more shares? If I issue more shares, 99 shares of £1 each, it may be required that I have to pay that £99 right from the off, and that might not be something I can do there. Maybe that might be the reason that I go for the chopping up. But if I do go for the issuance, and I'm looking to give this person, say, 10%, and I've got one share already, I decide, okay, let's try and get to a nice even 100. That means I could give myself 89, do the issuance, and at the same time issue 89 shares to myself, plus the 10 to this other shareholder, that's going to give us to go directly to 100, and then we're going to find ourselves with a 90-10 split.
Yeah.
In terms of the amounts to give that person, again, depends on what you want to get out of them. It depends on some of the considerations we talked about earlier. It depends on, if do I want to make sure this guy can never block me from any resolution whatsoever, in which case do I need to make sure it's below the 25% threshold? Am I okay with that? Will they even accept that? I'm sorry, it's very difficult to put an exact figure. How much should I give this person? You have to think about it from their perspective and your own perspective. What level of control you're willing to lose in exchange of getting your new business partner on.
Absolutely, and you can really see where these percentages are coming in and becoming really important when making these decisions. Yep. Now, Brian in Newcastle just wants a quick clarification here. Is shareholder another word for partner? My university lecturers would be beating me for talking about partners as if, just as if they were shareholders. For the purposes of this context, I probably would see it. Partners are generally associated with limited liability companies or regular partnerships, which don't have shares. But what is a partner? It's someone with an equity stake, and if they're a shareholder, you can't get much. I think it's almost immaterial here. If I'm talking about a partner in the context of a limited by shares company, I'm talking about them probably owning shares. Again, you'll see it with a lot of large companies as well. Some people get to a point where they stop calling themselves, the large limited companies. In terms of seniority, they stop talking about themselves as a director or something. They call themselves a partner. Hang on a minute, how can you be a partner if this isn't a partnership? It just refers to the shares that they may have. They have that equity stake. I think it's often used, particularly in some industries where maybe there's a lot of overlap with, say, the legal or accounting profession. They'll call themselves partners, maybe to give them that credence. But essentially where that derives from is the fact that, they've got a bit of equity, that they benefit from the profits of the company. Again, please don't shoot me and please don't report me to my university. I think in most contexts, if you're talking a limited by shares company, you talk about a partner, you probably talk about the shareholder. Yeah, it is one of the ones we see used interchangeably, isn't it?
Yeah.
So this one here from Sarah in Milton Keynes. Does a partner need to be added to my business bank account? Do you need to even give every partner access?
If you're just talking about the shareholder alone, I don't. The people that have that, normally in a limited by shares company, the person who has access to the bank account is the directors, the agents of the company, because they're looking after it. Remember, the shareholders are there to run the day-to-day business. The shareholders themselves, the directors are there to run it from a day-to-day business. The shareholders not necessarily, they're not expected to get involved, and maybe they shouldn't be getting involved. Of course, they're a director as well. So in the first instance, when we talk about, should I make my partner, give my partner access to the account? Well, that one depends on, are they just a shareholder? In which case, do they really need it? If they are a director, then generally speaking, they probably would expect it. Although again, it's not a hard and fast rule. You can actually remove a director's ability to be an authorised signatory or even to have access to it. I think if they're becoming a director, I think there's a certain expectation that they would have that authority to do so. So depending on exactly what role they have taken, it is very likely that you might have to do so. Unless, of course, they're just there as a shareholder, in which case, what is their position here? Yeah. One other point I would raise on that, what I would find is when we talk about partnerships and we talk about the shareholders, once you get over a certain percentage, generally speaking, the banks are going to want to know about them for their own due diligence purposes. Usually, once they breach that 25% threshold, they're an ultimate beneficial owner of the company with greater than 25% of those shares. Usually, when you're trying to do anything with the banks, they say, "Hang on a minute, who's this person here? I want to find out about them." So you'd be subject to those the person will be subject to those sort of compliance requirements. But again, I think that's different from actually having access to it. And if you're bringing on a business partner who's going to have an intrinsic involvement, probably being a director, that may well be something that you have to give them.
Yeah, we have reached that point of the webinar, so I am sorry to cut the questions short there, but we have kept everyone a little longer. Please don't worry, any questions that we've not got to, our team will revert back by email and get those answers out to you. So I promise we will endeavour to get answers out. Don't worry if we haven't got to your question. But if you do need any more support, we have the YouTube channel, speaking of, as I mentioned at the beginning of the call. This webinar will be recorded, it will be uploaded to YouTube. Give us about 24 hours and we'll get that up there for you if you did want to re-watch anything. Otherwise, like I say, if you do need any more support, we have our YouTube channel where you can see Nick speak about just about every topic you can think of in terms of companies and from a company's secretarial point of view. We have our blogs through our website. We also have our customer support team available by phone, email, and our live chat. So any questions you've got, jump on there and they'll be happy to help. We are also on Instagram as well. So give us a follow. And if you do join us next time, that would be fantastic. We'll look forward to seeing you there. Otherwise, any other questions, feel free to send them through to talks@firstformations.co.uk. But we hope to see you again next time. Thanks, guys.
Cheerio.